Good morning, everyone. Happy Friday. My name is Melody Kleoni. I am so excited to be doing another Freedom Fridays for you guys, where we come together over a cup of coffee every Friday morning at 10 a.m. Pacific Standard Time to talk about real estate, business, entrepreneurship, and what's going on in the market. Today, I'm sitting with my fabulous co host, George Martinez. Hey, George.
Hey Mel, super excited to be here with you. I already had a ton of coffee this morning, hit the gym, so pumped.
Awesome, awesome. Yeah, I know I had a couple of cups myself too, so I'm like ready to go. And also our beautiful guest this morning, Padi Goodspeed, the woman that needs no introduction because everyone knows who she is. She's been in the lending business for how many years now, Patty?
20. I'm in my 20th year.
20 years. She's a veteran. She's an OG. She knows what's going on in the market, and she is the lady to stay up to date with as far as numbers, market, news, anything that's going on with the, interest rates. She knows exactly what to do and exactly what to say. And so she's actually top 100 women loan originators in the nation, and she's with Cross Country Mortgage. So what's up, Patty?
Good morning. Thank you so much for that beautiful introduction. I'm so happy to be here with you too.
Thank you for making time for us. I know, you're a single mom. You've got two beautiful girls. You're running this beautiful business. You have a whole team of people working underneath you. You do so many things. You're on so many stages and get invited to speak at, so many panels and conferences and so many webinars. So I know you're a busy woman. Thank you for making time for us today. We're just going to hop right into it, you guys. I want to make sure that we're bringing you the most up-to-date, valuable information on what's going on in the market, because I'm sure everyone is reading the news headlines. Everyone is out there feeding into the media frenzy and all of the drama and negativity on what's going on in the market. Are we in a recession? Are we not in a recession? Is the real estate market going to crash? What's going on with interest rates? And so, this is why I wanted Patty on today, because I know, first of all, this week was a big week in the market. There was a lot of news that popped off. I know this because of Patty's beautiful written blog posts that go out every week. If you're not on her email list, make sure you get on her email list to stay up to date with what's going on. So Patty, let's pop it off. What is some news that happened this week? I know Monday was a big day. I think Wednesday or yesterday was a big day, and there were some announcements being made. So what can you bring us up to date?
Sure. So, the real big news was that we had the Fed meeting again. So towards the end of the month, they went into it, and then they come out February 1st, and they had a press conference. Typically, what my prediction was, what happens is that in these Fed meetings, people are expecting that the rate hikes impact mortgage rates negatively. And that hasn't been the case. We've talked about that a lot on various lives or reels or whatever. So what is important to know is that when the Feds meet, it's big news because it has a significant impact on the market. How the market responds directly impacts mortgage rates. So we had information about mortgage applications. We had information about the Fed meeting. And most importantly, which I've been emphasizing for months being extremely important, is job reports. We had lots of job reports this week. And so I noticed while we were trying to figure out our technical issues, when Jorge said, that, hey, I noticed that rates jumped today. Hey, oh my gosh, it just went up today. What happened? That's what we kind of want to go over. So in the situation, in this past week, we had news about the job report. We had news about jobs. We had news about inflation. We had news about the Fed meeting, and we had news about mortgage applications, because every single one of us have felt the uptick in activity and demand since the beginning of the year. So just to lightly answer your question and let you move on to others, the big news that we had this week was that, hey, the Fed's hiked rates again. What does that mean? So 25 basis point rate hike. However, the market improved. I actually waited to lock a few loans until the Fed announcement because I knew that the bond market would react positively. The reason the bond market reacted positively was because the Fed finally acknowledged that inflation was starting to come down. And what you saw today is that a big job report came out. So we were expecting, so economists were expecting that we were going to see 185,000 new jobs created. We got over 517,000 new jobs reported. How could we have that much more than expected? That the numbers have been very close to expectations, although higher than expectations, very close to expectations across the board. So I don't know how. I don't know what to make of that report. There's something off about that report. But when you have 517,000 new jobs created, that takes the unemployment rate to 3.4%. That is the lowest unemployment rate we've had since 1969.
Wow.
That means this, that good, if someone has a job, they're going to be working. We've talked about on my programs that we're saying, hey, we're going to go from people being extremely worried about interest rates hiking up, interest rates keep going up, I can't buy, I can't afford, to the question shifting to how low will prices go? And in that conversation that we've had, because you've said buyers or sellers really wondering, are we at the bottom when it comes to pricing? So one of the biggest things that creates that drive downward for pricing is a recession. You simply put, you cannot have a recession in an environment where there's only a 3.4% unemployment rate. So that's the kind of gist of what's been going on this week. And I'll just stop there so I don't, overpower the conversation and just take your questions and kind of break it down into pieces.
Yeah,
Oh,
no, I appreciate that. Keep going.
the point I was trying to make, which I forgot, I always forget because I talk so much, is that so the unemployment rate going to 3.4%, that actually, I believe that the bond market more so reacted to this other significant piece of information in the report, which was that wages grew. A couple weeks ago, when we were looking at the job report, we said, hey, wage growth was down. On average, Americans were working 1 hour less per week and their wages were not growing. In this particular report, actually, the most significant factor to the bond market jumping almost 50 points this morning and mortgage rates jumping is that the wage growth seems to be improving. So if we thought that people were going to continue to make less money, and those reports were proving that people were going to make less money, then the question was, is the economy going to slow down? Absolutely. But the issue is, this is a blessing, but the way that it works in the big picture is that if you're working and you're bringing in money, you're spending money. And as long as you're spending money, the economy is growing. As long as the economy is growing, prices are going to continue to rise. As long as they rise, then inflation will not stabilize or come down. We need inflation to come down in order for rates to continue to come down and for life to become more affordable for many of us, especially those of us tuning in from California.
Beautifully said, Patty. And how does that tie into unemployment rates? Because I know that that is a huge factor in the inflation, and the feds are looking closely at these numbers as well.
Yeah, that's a good question because unemployment is a big factor. The feds really focus on unemployment because what they've been, so imagine you're the Federal Reserve and you're like, shit, everything is going crazy. Prices are through the roof. We have to stabilize pricing. The only way to stabilize pricing is to hike up the interest rates. That is the Fed funds rate. The Fed funds rate, that's the supplier. That's your, like when they say don't run off on the plug,
Right.
the Fed is the plug, right? So the Fed is the one who's supplying the money to the banks. And so when that price goes up, then the price of everything then the growth starts to slow down because a business or a bank that's borrowing money from the feds at a 0% interest rate is going to do way more with that cheap money than they can do at a 7% interest rate or a 3% interest rate, right? So when they hiked up the interest rates, their job was to slam the brakes on the economy growing. Remember when you were selling a house 12 months ago or 8 months ago, and your buyer had to come up 25 grand above the appraised value. They had to commit to that just to get a bid accepted. That was outrageous. So basically that gives you a glimpse of why they had to stop things. So with that said, what the Fed is saying, the Fed was getting a lot of heat. Like, what are you guys doing? You're going to break the economy. The economy is going to fall apart. We're going to fall into a massive recession. And they were getting a lot of heat. Their response was, the job market is doing very well. We have a healthy employment situation. Unemployment numbers are lower than you've seen them since 1969. In the pandemic, they were up to 14%. And during the Great Recession, they were in the 24% range. So
Wow.
when you compare to 3.4, you're like, wait a minute, y'all. hey, maybe your business isn't booming at the rate that it was in 2021, but no one's dying here. Everything is okay. So we have this ability to continue to shrink the money supply for the greater good of our future, because if we don't get a grip on inflation, we're going to have bigger problems. Those bigger problems, very simply put, translate into Melody, Jorge, and I would have to each work either 2 times the hours we're working now or make 5 times the wages that we're making now if a 5% inflation rate was sustained over 5 years. Have you ever heard the phenomenon of compounding interest? The reason why they say if you put $1 into your stock market now and you leave it there for 20 years, that compounds over time, because the dollar becomes $1.25. Then the $1.25 starts compounding. Then the $1.50 starts compounding, right? It gradually adds and compounds. So when you think of it that way, then you understand that if inflation was to continue to even just maintain itself at 5%, the cost of goods and services would be going up by 5% every single year after year. If your wages remain stagnant and inflation continues to rise, you're not going to be able to afford to live. We're all moving to fucking Alabama and Tennessee, right? So you know what I'm saying? So that's the problem. So when they're like, so the Fed's saying, no, we have to continue to raise Fed funds rate. We have to continue to constrict the money supply and stop growth. Otherwise, this problem is going to be a way bigger problem than it is for us right now. And they have admittedly said that there is no painless way to get back down to a 2% inflation rate. So to your question about unemployment, every factor is relative to inflation. Inflation is also impacted by supply and demand. So if you think of supply and demand, a very basic law of economics, that applies to us in everyday life, in our jobs and our homes and the market, yada. And I'll explain. So if you have, like, the labor market also has supply and demand. Supply is the amount of laborers, the workers, and the demand is the amount of work that is required to be serviced by the employees, right? So that also, when that gets out of whack, so that if there's way more jobs than there are workers, that's a problem. And if there's way more workers than there are jobs, then that becomes a really big problem. And so what happens when wage growth is being reported to be on the upward swing in this last report, that's considered inflationary. That means that, we've had some good news on inflation coming down, but if people are making more money, that's an inflationary situation because they have more money to spend and wages are growing. Any number that's growing is inflationary. When it's coming down, it's deflationary. And we want the inflation to go from 4.4 to 2%. So this pickup in demand that you have experienced, all of us have experienced, is because interest rates peaked at 7+% and they drop back down now, and you're even getting loans under 6%. So when buyers are feeling like, okay, prices are getting stable, interest rates peak, I'm now feeling a little bit more confident about getting in the market, and then you're met with new objections and rebuttals to come up with. So I'll stop there. Sorry.
Wow. I love it. That's crazy. George, what do you want to add to that?
I've been working with a handful of buyers right now. And so one of the biggest objections that I've been seeing is that one of my clients actually works at a financial bank. So one of her biggest fears that she shared with me is that her bank told her that there's going to be 3 interest rate hikes this year. So she's kind of been thinking, like, you know what, we're in a market downturn, but as rates have kind of slowly dropped a little bit going into 2023, they've been kind of seeing the opposite happen. So what would your suggestion be kind of to best maneuver that conversation with those buyers or those sellers that are coming up with the sudden interest rate spike and then drop? And then, because right now I know another objection that I've been getting myself is that, hey, you know what, 6 months ago, why is this interest rates were obviously much lower, but they're higher now. So why am I going to pay that same amount in home value when the interest rate doesn't add up? It's completely different.
Yeah. So the first point to the client who's using the bank. First of all, I still don't know, as a consumer base, why we all continue to support large banks, especially with mortgage activity, despite the tremendous amount of fraud that takes place on bank levels and also declines for no reason. So that's just my little side note there, my venting. But banks, when you go to a bank, remember we said that the Fed funds rate directly impacts the rate at which banks borrow from the government. Okay. So when every banker is talking about interest rate hikes, I've been saying this for like 5, 6 months now, or whatever it is, but it still doesn't catch on. I'm just a little speck of dust in this big grand scheme. But the point is, many people don't understand that the Fed hikes are not directly correlated to mortgage rates. So the example that you give to each of your clients that talk about the Fed's hiking rates is to help them understand that that is not directly correlated to mortgage rates. The mortgage rates are directly correlated to the bond market. So if you're watching the stock market and you're watching the bond market, when bond prices go up, mortgage rates go down. So today, the bond market went down by 47 points just before getting on this call, which means interest rates for mortgages went up. The bond market is what you're watching that directly impacts. So what impacts the bond market? The bond market is a bunch of investors. So if we were investors, right, and we were going to buy a house, what would give us confidence to pool our money and buy a house? Let's say we all got to have equal ownership in the property. So we're going to look to see, if I decide that I'm going to invest my money in this house with Melody and Jorge, how can I feel confident about this investment? I'm looking at the news, right? Jobs, demand, inventory, how long is it sitting on the market? What do the comps look like? There's a bunch of data that impacts my decision. The bond market is the same. You have investors that buy bonds. They're not going to buy bonds if they think they're not going to perform. And right now, the bond market is reacting to things like, in news of inflation, Fed sentiment about future rate hikes, and they're also reacting to the job market. Why? Because the Federal Reserve is very focused on saying that if the job market continues to remain strong and resilient as it has, then we are right in our approach to constrict monetary policy, which means we can keep hiking rates, and the economy is not going to break, because we have to get from 4.4% core inflation to 2% inflation. So if you and I owned a store, Jorge, and we needed to get our prices on t-shirts from $10 down to $5, what would we have to do? We would have to have a lot more t-shirts than we had customers. So those t-shirts are going to be sitting on the market before we decide to slash the prices by 50%. Okay.
Wow.
So that's a great analogy to understand this. So when your buyer is coming in and they're showing hesitance because they're saying, my banker said rates are going to go up, be like, yeah, your banker must be paying attention to the Federal Reserve's sentiment that they want to continue to constrict the money supply. The Fed funds rate is not directly correlated to mortgage rates. We have to watch the bond market for that. The bond market responds very well to news of inflation coming down. If mortgage rates were going to increase at the same rate of the Fed funds rate, then the mortgage rates could not have possibly come down from 7% levels down to sub 6% levels today. I understand your concern. Please give me an opportunity to set you up with a mortgage banker that can help you understand what's going on in the market so that you can feel confident while you're shopping. Now, the other thing that we've seen very frequently in our market news and updates on Instagram is we hear people have picked up, I said this long ago in my webinars and they're recorded, is that you have a very short window of opportunity to go and negotiate on your terms. Based on the demand we all experienced in January, that window of opportunity damn near disappeared. How many offers were not accepted that were asking for credits? How many offers were not accepted because someone came in higher? How many offers were not accepted that asked under list price? There was a lot of them. So, and then we also had the lack of contingencies also playing a large role in getting an offer accepted, which leads to what? You have a competitive market. Why? There's not enough inventory. So, ma'am or sir, I understand your hesitation because there's a massive difference in your mortgage payment when this time last year you could have got a 3% interest rate and today you're looking at 5.875. But let me assure you that as inflation comes down and mortgage rates continue to come down, demand will rise. And in a tight inventory environment, that is going to lend itself to stable pricing. So in hindsight, in 2025, when you look back, you would say, I'm really grateful that I bought during that window of opportunity, during that dip, because had I had waited until things were more stable, then I would have paid $15,000 or $20,000 more for that same property.
That brings me to my next point. When I talk to buyers, it's interesting because everyone is really obsessed with the fact that interest rates are going to 7%. I even had someone tell me the other day that they think interest rates are going to go to 9%. And here's what I like to tell them, and tell me if you think this makes sense, Patty, but I like to say, well, you know what? It kind of balances itself out, because if you were to purchase a property in 2020 and get that 2.5% or 3% interest rate, that would have been a low rate. Great, congratulations. But you would have had to pay 20, 30, sometimes 50% over the listed price in some markets in order to get your offer accepted. And then how long do you think you would have to sit on that asset in order to recuperate some of your money and for it to appreciate? A very long time, because you're overpaying, and not to mention all the homes that were not appraising for the values that people were paying for. Now interest rates are at 6% or at 5% or whatever they're at today, but you're not having to overpay 40 or 50% over the property's value. You're getting something right at asking price, maybe even less than asking price in some markets, and you can always refinance that rate later on when they come back down. Does that make sense to say to a buyer?
It does. I think it makes sense to say, and it hits harder when you add data in it. So when I add data into the conversation with you guys, it's like, oh wow, fuck, that makes sense, right?
Yeah.
So that's the same thing a buyer's going to think. And the data points for that, for me, in my opinion, is that, so what the problem is that when you talk about price shifts across the nation, like with the Case-Shiller report and various people, economists who are making, or not even economists, 22-year-olds who are making TikToks about their long experience in life. So what happens is you're seeing a lot of tidbits of information that don't make sense. But
Right.
when you look at that, you say in San Francisco, there was about a 24% price correction. You would say in Concord and Walnut Creek, there was no price correction. Right. And we have the what I like to tell buyers is the only thing I would add there is that, you know, I would say, Jorge, I appreciate that you've brought up this concern. I want you to understand that really what has been eliminated from the market has not impacted the actual value of the home, because the homes 8 months ago weren't actually appraising for the purchase price in every situation. It was the buyer's willingness to pay a premium above the value of the home that drove those prices up. That was unsustainable. The buyer knew, because they had an appraisal and they had the comps and they saw the list price. The buyer chose to write a check for the premium because their stock account was robust, their income was growing, and they could afford to do so. In this market, you do not have buyers writing those premium checks. That's the difference between the acceleration of equity that's taking place now being normalized. Is it that the value changed, or is it that the buyer writing the check for the premium is no longer writing that check? Massive distinction that I think is missed on a lot of fronts. Massive distinction. So I think we need to talk about that. Then also the data. Every real estate is the most hyper local business. We are digesting national news on a daily basis, but it's a hyper local business. If I'm talking to a buyer in Oakland, I don't have the same story as a buyer in Walnut Creek, or the same story as a buyer in San Jose, or the same story as a buyer in Tahoe. There's a different story, and the story is told through the data. Sit down with folks and show them how homes have been listed and sold over the last 90 days within a 1-mile radius of the property that they're looking at, and a lot of those myths will get dispelled. When someone is in their emotions, take them to the facts. Facts is the only way to balance emotion. Math.
That's exactly right. And that's why we have someone like Patty on our side, right?
Amen. Because I'm a nerd and all I do is read.
No, but I love that you said that about using data to really get the conviction across, and when they kind of give you that objection, because something that I've done for the last year is I actually have an Excel spreadsheet on about over 40 different Bay Area cities, and I do single family homes. And so when I do my buyer consultation, I definitely feel like showing that data and spreadsheet to my buyers as to why they're going to pay more of a premium in San Leandro when they have 17 single family homes on the market versus in maybe Antioch, where there's 120 active homes on the market that day. And I use that data to kind of combat, this is why you're probably going to pay more in this area versus if you go, you're going to have a larger inventory.
You hit that so beautifully, Jorge, because the phenomenon of paying a premium for a property doesn't exist in an environment where we have a surplus of inventory. So back to our t-shirt analogy. Our t-shirt analogy was if you and I owned a store and we needed to get our prices down from $10 to $5, we would have to have a massive influx of shirts coming in from the manufacturer and no buyers at our door. That would be the only factor that drives us to cut the prices. So when you think about it in the most simple terms, the phenomenon of a premium exists in an environment where inventory is low. Normal inventory levels are 6+ months. We are half of that, if not less.
Is it,
So
what
we
is
don't
it, 2 months?
It's 2.9 in many cases if you look at the average across the country. Homes are staying on the market approximately 14% longer, and we all know that those are the homes that the seller couldn't afford to do the facelift on, right? Because the ones that look good are still flying off the shelf.
Yeah.
We have a deal in Clayton, California, in contract at $3.5 million. That home was listed for $1.1 million. We examined that last night. $1.1 million, 20 offers, in contract for $1.35.
Wow.
I think actually, I know what property you're talking about. One of the team members on our team wrote an offer on that. She came up in second or third place, I think, but it went way over asking price. Not to mention in Alameda, California, we made an offer on something last week. There was 8 offers on that property. Concord, California, we wrote an offer, or one of my girlfriends, Kate Hudson, who I'm sure you guys know, wrote an offer on a property. And she said there was 15 offers on the property. And so if the property looks good, if it's in a good location, you're absolutely right, Patty. Those are flying off the shelf. But I believe that a lot of listing agents, unfortunately, are still acting like we're in 2020 or 2021, and they're listing properties inaccurately. And those are the properties that are staying on the market for a long period of time. But here's what I like to say to people: you don't get paid for sticking a lockbox on the water hose and sticking a sign outside the front yard. You don't get paid for that. And the seller doesn't get served in the highest form by you doing that either. You get paid for giving people correct data, and you get paid for pricing properties properly and getting that sold and getting the money in people's pockets. That's how you get paid. So, I think those are the hard conversations that a lot of agents are just not willing to have with their clients right now because they just want the listing.
Yeah. Very, very wise assessment.
Yeah.
What's interesting too is I've written a handful of offers actually in the last 2 weeks for a few different buyers in different cities, and just seeing the data, as Patty was mentioning, it's definitely interesting because I wrote at a 2.5 for my buyers, and the property ended up going $400,000 over the asking price, waiving all their contingencies, considering the amount of rain we just had, and this property was built into a rock. So
where was it?
And Burlingame. It was listed. Yeah.
And Burlingame has massively low inventory, right?
Correct.
Great schools.
So
you wrote at 2.5 and it sold for 2.9?
2.9. And this was right in the first week coming into January. And then I just wrote an offer 2 days ago in Sunnyvale. It was a fixer. It was listed at 9,999. And we ended up submitting 1,114. And they got 20 offers. Ended up going for, I think she said 1.3. But granted, it was a fixer, and I will say it was probably about a mile from Levi Stadium.
Did it close?
It hasn't. It just went into contract this week.
Did the Burlingame one close?
It has not yet. It was just 3 weeks ago.
It's so interesting to see what's going on in this market. It's so hyper local. It's not like you can say we're in a recession or the real estate market is crashing, because it's like literally subdivision by subdivision almost. It's so different everywhere you go. So it's like that the news headlines and everything that people are reading in the media right now couldn't be further from the truth, especially when you talk to people that are out on the field like George and I, like Patty and I, you can't sit there and justify what you're reading in the news headlines. I know that Patty, last week on your your webinar that you do, your weekly webinar, The Truth Behind the Headlines, which if you guys haven't attended a call, send me a DM. I'll hook you up with Padi. I'll send you the link. You guys have to be on this call because she goes off. And it was so eye-opening because you said that, someone was reading a news headline, I believe, a specific one, and refresh my memory on that. It was like, couldn't be further from the truth. And they were just saying something for the sake of saying it, and you were like correcting them on it. Does that sound familiar?
Oh gosh, I don't remember which topic because there are so many of them. I don't know if it rings a bell on exactly what the topic was. Let me know. Yeah, I don't remember which specific headline, but I think we were really talking. I want to say about the job report, very similar to what's happening now. I didn't want to get too into the weeds, but I'll give you an idea. On Wednesday, the ADP report came out. So ADP is a big company that manages all the payrolls, right? Like we've all heard of ADP, right? You get a check from ADP. So what happened is they said that the new jobs that were created was 105. Let me make sure I wrote 106. 106 new jobs were created according to ADP. So how did the report that came out today indicate 517 jobs? So the number is about 864, and actually over 600,000 of those jobs were part-time. So how do we factor in, how did they change the structure of this report to be 5 times what ADP, who's issuing the checks, came up with? Kind of fishy, right? Something's not adding up. So instead of calling conspiracy, really the thought really is not about that. It's about how is the data so different in two important reports? ADP report is not that big of a deal. So basically what you see is you'll see these headlines that say, oh my gosh, there's 517,000 new jobs created. Are they ever breaking that down to tell you where that data is coming from? No one knows where the data comes from. They're just regurgitating the headline, right? And the story that the headline doesn't tell is that a lot of those jobs are part-time, and a lot of those jobs are basically saying that, like me, Melody, and Jorge also needed to go pick up more jobs in the gig economy to be able to survive. So the higher prices is creating this opportunity for more people to go out and get more jobs. So even though that solves for the unemployment rate completely tumbling, does it really reflect a healthy economy if I have to work 2 jobs to live? We don't know that. That's why inflation is so important. So that's a mild example of how we break down the headlines. There's been other ones that talk significantly about the difference between renting and owning that we've gone over. Oh, we talk about, there's lots of gloom and doom about foreclosures. People are saying that, the people are going to suffer, foreclosures are picking up. The data has not moved at all for 90-day lates and foreclosure proceedings getting started. Has not moved in 2 quarters. So you don't have any uptick in any of that. People are not hurting financially. What's happening though with the Fed funds rate going up is that if you have $20,000 worth of credit card debt and you're used to making $150 minimum payment on that debt, that $150 payment just turned into $300. The mortgage, the Fed funds rate severely impacts credit card balance holders. So when you hear the news about savings going down, let me ask you something. If your income hasn't changed, you have 2 hours of less overtime opportunity at work, your credit card minimum payments just doubled. How are you supposed to have money to save?
Right.
The average American was spending $470 a month more on just groceries and gas.
Right.
So if I'm spending more on groceries and gas, my minimum payments doubled. I no longer have the ability to say, I can meet you for girls' night on Thursday for dinner and drinks. I don't got the extra $150 to spend.
Right.
That's the difference, and that's the shift. So the truth behind the headlines, there have been some more, exciting topics, but these are some of the boring ones, more mild examples for our audience today to understand that we are in a situation where the headline is not telling the full story. You have to break down the truth behind the headlines from an economic standpoint, but also because real estate is very hyper local. So the job market in Oakland, California might be very different than Martinez, California, and very different from Sunnyvale or Palo Alto when you're comparing it to Stockton. So you have to kind of realize that what's happening before we jump to conclusions. The act of jumping to the conclusions is exactly what consumers do. Consumer behavior is the number one factor in how the markets move, because a business is not growing if you're not spending money with them.
Mhm.
A political thought I've always had is that we vote with our dollars. Where you spend your money, you are empowering whatever that system, service, business, or person is. So you should support what you want to empower. So if you
Mhm.
stop spending money somewhere, that entity can't grow. Okay. So,
Mhm.
anyways, that's kind of big picture things, getting on a tangent. But the whole point is that the headlines are very broad, and it's important to understand where they come from. Headlines are designed as clickbait, not news.
Mhm.
Right. 100%. Love that, Patty. I love the way you explain things. Doesn't she explain things in layman's terms where people can literally just understand? Like, if this was anyone else or if this was on the news, I would be like so in over my head. But the way she explains it is
Yeah.
amazing.
No, I definitely love it. I love how you paint the picture and you tell the story, because I'm a visual person. So as you speak about it, I'm imagining it in my head.
Yeah. So we talked about why the job market matters. We're talking about how unemployment claims have risen by more than 300,000 over the last 4 months. I believe according to your newsletter, they're at 2.1 million right now. And then unemployment rate is at 3.5% right now. So why don't we move on to the subject of how low will home prices go? I mean, what do we see right now as far? I know that inventory levels are a huge factor in this. As you said before, we're at 2.9% or 2.9 months worth of inventory, excuse me, in our local real estate market here in the Bay Area. But you know what do you think is going to happen with the home prices? Because I think a lot of people are on the fence right now about wanting to pull the trigger on purchasing a home, and they think that home prices are just going to continue going down, even though we're seeing this hyper local movement coming on. As George said, Burlingame, is going crazy. Concord is starting to heat back up again. Alameda is heating back up. So, how do you answer that question, and how do you sit down with people and really talk to them about it in a way that they can understand?
Mhm. Yeah, I have a client in mind that is looking to buy, and he analyzes what can happen 4.5 years from now when he decides to move out of the state. It's insane. So he's overthinking the process of buying the house. I told him, if the stress of buying a house is this much for you, because there's nothing we can say today that could give you any sort of projection of what's going to happen 4 years from now, just step out of the game.
Yeah.
And I think that sometimes we have to approach people that are highly anxious about the process and over analyzing, and just say, Jorge, I understand this can be an extremely stressful decision making process for you. I think you should just take a break from it, you know?
Mm,
And that alone would take all the defenses down. Why?
mhm,
Because if you see that someone is anxious about a decision, trying to convince them that it's going to be a good one is just a waste of your energy.
right.
Let keep it. So one of my biggest things that I teach or say or whatever is that meet people exactly where they are in their thoughts and feelings and emotions about this. Be human. Be human first, realtor second.
Mhm,
I understand how you feel. I understand your fears and concerns. Now, I'd like to offer you an alternative thought. An alternative thought would be that if you were to purchase this property today for 750,000, and by January of 2024, let's say that property value went from 750 to 735. Okay. So were you planning on selling in January? You
right.
don't win, you don't lose, you don't win or lose any money until you sell. And
Mhm,
how you buy is extremely important.
mhm,
And as an investor, we understand that the acquisition price plays a massive role in the long-term gains or benefits of the ownership of the asset. So
mhm,
now as an owner of your primary residence, your very first question needs to be, is this a home that I can live in for the next 5 years?
mhm,
I'm pretty sure you're not deciding to make the sacrifices, the purchase, and go through the moving process to live in this property for 6 months, and you're worried about what's going to happen to the price over the next 6 to 12 months.
right.
I can tell you that over the last 6 recessions since 1980, home prices on average have only come down approximately 5%. This is
Mhm,
according to a detailed Harvard study.
Mhm.
Out of the last 6 recessions since 1980, they've lasted an average of 6 months, and home prices have on average gone down by 5%. And home prices were only impacted out of 5 of 6 of those recessions.
Mhm.
So if you bought the house today and we were dead wrong about the market, and I was wrong, and
Mhm.
you lost some money, your value went down by $10 or $15,000. I want you to know that because you've decided to stay in this home for the next 5 years, you will not be impacted by that. You don't
Mhm.
win or lose until you sell. How long were you planning on staying in this home?
Right. And I think that it's interesting because the market was going up so rapidly in the past 4 or 5 years that people thought that they could just buy a home, live in it for 6 months or a year, and then all of a sudden they could turn around, flip it, and make a killing on it. And that's not happening anymore.
Mhm.
And so I think that a lot of home sellers right now are struggling with that because their house isn't worth $2.5 million, compared to Susan's house that sold across the street 2 summers ago, and they're still thinking that it is. So it is, you're 100% right. It's all about the data, sitting down with people, educating them on the market and the facts, and then letting them make their own decisions instead of pressuring them and saying, no, this is a great time. You might be losing $200,000 on the purchase, on the price of your home, but you should be selling anyways.
Mhm. Well, that's the thing. You're only talking about the difference in sales price if they're selling. So if they're a buyer and they're fearing that they're buying and they're waiting for the bottom, in economics, that term is called trying to catch a falling knife. So
Right.
try to catch a falling knife.
I
That's
love
a
your
tough thing to
saying.
do. You can't do that, right? So you're not going to catch the bottom just like we can't catch the top. Anyone that tells you otherwise is being disingenuous. So Jorge, I'd like to ask you, if you're certain about the process of looking for a home, let's start just the discovery process. Let's
Mhm.
go and get a feel. Let's watch homes that you like and see what they go in contract for and see what they sell for. The
Mhm.
price of anything is what someone is willing to pay for it. Demand is what dictates price stability. At best case scenario, Jorge, the home that you buy is going to maintain its value for the next 18 months. At worst case scenario, you're going to lose 5% of that value. And what economists are thinking could be the average case scenario is that your home value would increase by 3%.
Mhm.
The better news here is that you decided that this was a home you were going to buy that you could live in for the next 5.
Mhm.
It would even take 2 years for you to be able to sell this home and not have any tax implications. This is not a short-term decision, so I don't want you to allow the short-term data of the news of the economy to impact your decision and shut you out from this opportunity to buy within this window of opportunity to get a better price. Now, again, this is coming from not from a sales perspective. This is coming from the perspective that this client has been vetted, they're approved, they're within low mortgage, debt ratios. They can certainly afford it. And when we do the math on an Excel sheet with a lot of clients, we often find on average $2,200 a month of net income that's unaccounted for. I don't know where I spent that. I don't know where I blew that. I don't know what I ate. I don't know where I went. I don't know where that money's going. So if you take a look, if you're a buyer and you're watching this and you take a look at your net income and you take a look at your housing expense and your car payments and your credit cards, and at the end of the month, you see what that number is and you're asking yourself, where is that number going? You can 100% afford to buy a house. It's about making sacrifices that make sense.
Mic drop.
I love that. I'm definitely going to watch this back a few times and put that into my lingo with my clients.
Yeah, and just as a reminder, if you guys are watching, spread some love for Patty right here in the comments. Let us know where you're tuning in from. What city are you in? What market are you in? Let us know, that you guys are tuning in, and throw an emoji in there for Patty because she's absolutely fabulous. I love to do this with her at least once a quarter because I think that it is so crucial to stay in front of this data and to be able to bring this to our clients, to our friends, to our real estate team, and to really be able to own the fact that yeah, the market's not what it used to be, but here's what's actually going on. And that's why I love talking to you, Patty, because you're able to really give us the data, and you're so up to date with everything. And so we've kind of talked about the news for this week. What are some other big announcements that are happening or have happened this week that we can talk about and let people know what they should be expecting in the next couple of months or in the next few weeks even.
Yeah. So we talked about the big headlines this past week, and going into February and March, we know that it's going to pick up a little bit just from a seasonality perspective. People are getting ready for the spring market. And then we all know prime time in real estate has been March through September. In the last few years, we haven't really experienced prime time. It's been prime time around the clock. So I think we're going to see a pickup in demand for that reason. I think we're going to see a little bit more inventory coming onto the market. So I think the news to watch for, the key things you want to watch for and ping me if you have questions on what it means for us, is going to be inflation, CPI reports, mortgage application data. Mortgage application data is a direct reflection of the demand and lead volume you're seeing. My lead volume went through the roof. I'm sure yours did as well. So we have lead volume that picks up as a result of mortgage application. So mortgage application data, CPI data, anything that has to do with inflation is something important to watch. And of course, there'll be another Fed meeting upcoming in March that we need to pay attention to. The Fed sentiment, there is starting to be a slight disconnect between what the strong stance the Fed is taking and how the market is absorbing that. If you think about it, and the markets was expecting 185 jobs being created, and there was 517,000 new jobs reported. That's an astronomical shift. Under normal circumstances, such as the volatility we saw about 90 days ago in the market, that would have driven interest rates up by a whole percentage today, but that didn't happen. So the markets are starting to see the big picture, and they're starting to understand that the Fed wants to slow down the economy. If your purchase applications and your buyer demand starts to pick up significantly, and the price of goods and we see that wage growth is happening and people are working, you're going to see that inflation is not going to go down, and that's going to be a problem for mortgage rates. So that's what we need to watch: inflation, unemployment, the cost of goods and services. Keep an eye on mortgage applications, and of course, my webinar will be on the third week of February, third Thursday of February. And the link is in my Instagram bio. We're going to huddle up and talk about it there. And I also invite everyone to use what I say to go make your content. Just give me some credit for it.
I love it. George, did you have anything you wanted to say?
Yeah. So I was actually going to ask you, so it kind of ties into everything that you've been talking about, with a lot of people kind of also being a little unrealistic sometimes when they're entering the job market. So right now, for those people that do have that extra funds, or they're kind of trying to go for their dream house right off the bat, what is your advice to those folks in getting into more buying the ugliest house on the block, and then starting to build their real estate portfolio that way and really become an investor versus just going straight for their dream home right off the bat?
Yeah, I would love that, because that's how I operate. I'm not a bargain shopper with a lot of things, but when it comes to real estate, I have been. I bought my own house that I'm living in right now at about 80 grand below market in August 2020. So, and how did I get a property below market in a peak market state? Patience. Right? I didn't go for the house that everyone else wanted. I went for the one that had the divorced couple, and the inside looked like shit, and nobody wanted to write an offer on it, because I knew that I would save the money on the property. I would hedge against what I thought would be a peak market, and I would go in at a price that I can afford, and I could gradually turn it into what I like. I still haven't landscaped the front of my house. It looks ugly. You come into my house, and when you walk into the front door, you're like, wait a minute, that's a different house, and anyone who's been in my house will tell you that. So there's still a lot of things I haven't gotten to, but I'm also not upside down on my house. I didn't lose any money on the value of my property. So if you're a first time home, I have another client, beautiful, smart, hardworking, makes great money, has a partner. She's doing it on her own. She just bought a house that was purchased by Open Door for almost $1,050,000 back in November. And they sold it to her for $835,000, and it appraised for $885,000.
Wow.
You're walking in equity. Now, you know what house she wanted? She wanted the 1.2. She wanted the 1.3. And guess what? A little bit of patience and a little bit of resistance from her lender got her. Walked into equity and hedged against what could potentially happen. So Jorge, you bring up a phenomenal point. That's why it's so critical for us as the professionals to get them out of their emotions and right into the facts.
Yeah.
If your girl is going crazy or your partner is acting emotional, just do some math with them. It clears it up every time.
Yeah, I've definitely got a couple of those in my pipeline right now that I think I need to sit down and have a conversation with.
Math does the trick. Get people out of their feelings and into the math. When you're buying real estate, be patient. If you are wanting the house that has all the bells and whistles, you're paying the premium. Remember what we talked about the premium? Don't confuse property values for the premium that a buyer is willing to pay for a house. That's why they'll teach us in real estate school that if you build a golden pool, you did not, and you spend $1 million on it, you did not just increase your property value by $1 million. You just put a $1 million pool in the back. And you're hoping that the curb appeal makes it so that a buyer would pay more for your home. There's a very big difference between that and market value. So as long as we can teach that, I think we're going to help people keep things into perspective.
Right, exactly. And there's so many, I mean, next week we're going to have an appraiser on the call. We're going to talk to an appraiser about exactly what's going on with the market, because I just had, some homes not appraised recently, and it was pretty interesting. It was like we were back in 2020, and the fact is I think that a lot of people are really walking into this new market not really knowing how to navigate it. And so the more educated that you can be, the more that you can sit down with your clients, the more people that you can have, like Padi, or like my friend Anthony, our appraiser, coming on, that can give you armor, which is the knowledge and the data of the market. It's going to be the most important. So we thank you so much. George, anything you want to add?
While we were sitting here, guys, key factor, look, while we were sitting here, 41 basis points is what we were down. Now we're up 11. The bond market is already bouncing back, and whatever we lost on interest rates this morning, I guarantee you we're going to gain back by Monday. Why? Because that job report was full of shit. We'll talk about that on my webinar.
So give us some information about how people can find you. How can people connect with you? If they want to sit down and have a one-on-one with you, where do they go?
Oh, thank you, Melody. Bookwithpadi.com. My name is Padi. It's short for Padide on the screen. So it's Padi. I'm Persian and I'm single, just in case anyone has an uncle or a brother over 40 ready to date. So no, just kidding. So Padi, it's Book with Padi. There you go. Thank you so much. That's the best way. I'm Padi Goodspeed across all socials. I'm very responsive, very easy to reach, very easy to find. Like Drake says, same city, same friends. If you're looking for me, I'm here.
Ooh, I love it.
He's like on fire today. I love it. Another saying that Padi got me, going on is, the greatest magicians are mathematicians.
Yes,
love
that's
that.
what I teach my daughters. Yeah. Mm-hmm.
Yeah, I love it. I love it. George, why don't you wrap it up for us today?
Well, thank you so much once again, Padi. It's always a pleasure. And I know now you love rap, which I love.
I'm a gangster right inside here. That's what I am.
And you got some power dance moves. I saw you at Elias's event last time.
Okay.
But we don't talk about that in public.
No worries. Anywho, everyone, thank you so much for joining us on today's podcast. It was such a pleasure. We hope you took a lot of golden nuggets. As Melody said, Padi is a phenomenal resource. Definitely jump in her DMs, shoot her a follow, jump on her webinar. You definitely don't want to miss out, because if you thought today was fire, her webinar is creme de la creme. So join us next week at 10 a.m. for next week's Freedom Fridays.
Yeah, love it. Thank you so much, Padi. I really appreciate you.
Oh, I wish we could have ended this with a big fat hug. Thank you so much.
I'll hug my laptop.
I will definitely be sending this recording out, so please make sure you share, like, subscribe, do all those things. I don't know how this works out because it's a Facebook Live. It's something new that we're trying. If there's any feedback that you guys have for me on a way that I could make this better for you or to enhance the experience, please don't be shy. Let me know. I am here for you guys as a resource, and I would absolutely love to help you, whether you're in real estate yourself or whether you're a buyer or a seller. George and I, we like to partner up together on those types of things. So please let us know how we can give you some more value and to make this a better experience. Peace.
Bye.
Ciao.